Hey everyone, and welcome back to the Rich Habits Podcast, a top 10 business podcast on Spotify. My name is Austin Hankwitz, and I'm joined by my co-host Robert Croak. Robert is a seasoned entrepreneur in his 50s with lifetime revenues of over 300 million, and I'm an entrepreneur in my late 20s with a background in finance and economics. Since quitting my full-time job in corporate finance a few years ago, I've built a 7-figure media business and actively advise some of the most well-known fintech companies around the world. And as the show name might suggest, every episode we talk about rich habits as they relate to business, finance, and mindset. However, we try and bring you two unique perspectives, one from an industry veteran, which is Robert, and the other myself, someone who's still in the process of building wealth and figuring it all out. Robert, this is a special episode. We got a special guest with us, so break down who this is and what we're going to be talking about in today's episode.
I love it. Yes. On today's episode of the Rich Habits Podcast, we're joined by Jeremy Schneider. You might recognize him instead as Personal Finance Club on Instagram, where he has over 619,000 followers, which is really, really amazing. Every week, he posts educational graphics that help debunk and demystify the lies we see in the headline news and on social media every single day about personal finance and investing. And he inspires millions of people to begin their wealth building journey just like Austin and I do. Jeremy, thanks for joining us. Why don't you tell the listeners a bit about your story, where you came from, how they can find you, and then we can get right in.
I guess my story started in college. I had a job offer from Microsoft to go work as a computer programmer and decided that corporate America wasn't for me and instead decided to start a company. I had no idea what I was doing. I was Googling things like how to start a company. I didn't know what forms you had to fill out. I had no clue about building a brand or product or revenue or anything like that. But I was very stubborn and stuck with it for years. And the most I ever paid myself was $36,000 a year. I never took any venture capital or funding. I just bootstrapped, basically spending less than we made along the way. Eventually hired up to 7 employees. And then I sold the company when I was 34 for just over $5 million. And so I went from being, living borderline poverty level in San Diego on $36,000 a year salary to, being a multimillionaire literally with the click of a refresh button on my, checking account website. For a year after that, I did what I thought you're supposed to do as a young retired person. I traveled, I played video games, I worked out, every day was a Saturday. That was fun for sure, but I lacked purpose and tension in my life. And so then I started following my passion, which is teaching people about personal finance and investing, which is what I do now under the brand Personal Finance Club. And so like you said, I kind of just teach the basics of personal finance and investing, almost all the same messages you guys are giving here on your podcast.
Well, we're definitely going to get into what happens when all of a sudden millions of dollars end up in your checking account. I've been there a couple times and obviously with Silly Bands in a very huge way. So I can't wait to cover that later on. But yes, as you alluded to, Austin and I have several money topics and slogans we believe in as it relates to building wealth through personal finance. But we'd love to hear your perspective. Give us 3 things that every listener right now should know about money and building wealth, and we can see how much they line up with what we believe, because a lot of your message is similar to ours, but everyone has a different mousetrap because personal finance is not a one-size-fits-all.
For sure. And I love what you guys do because when we grow up, we have this misconception about wealth, I think. You think that wealth is driving a fancy car or making it rain at the club or whatever, but I don't think that's what wealth is. That's spending, right? Wealth is what's left over after you have spending. And so I'd say the first tip is live below your means. We all know people who make healthy 6-figure salaries who are living paycheck to paycheck. If you make $500,000 a year and you spend $500,000 a year, you're broke. You have $0. But if you make $60,000 a year and you spend $40,000 a year, that $20,000 a year you're not spending, you can easily become a multimillionaire. So that's the first thing. You have to live below your means. I say the second is to invest early and often. With that money that you're not spending, just regularly dump it into investments. The 2 things I invest in mainly are the stock market and real estate, things that pay you for owning them over time and are likely to go up in value. And it's not about timing the market. It's not about guessing. It's not about speculating. It's not about gambling the market. It's just about consistently buy over time to ramp up that compound growth. And then the third I'd say is keep it simple. The first time anyone dips their toe into the world of investing, it's seems impossibly complex. There's visions of Wall Street traders frantically waving pieces of paper over their head on in Hollywood movies, or day traders with 14 screens with a million charts trying to predict what's going to happen, or, crypto or futures or options. But the reality is The best investors keep it very, very simple. They buy a few things, maybe even one thing, and just keep buying more of the same thing over time. And so, my favorite way to invest is just to buy one single thing, which is called a target date index fund. Like, my net worth now is over $5 million. I'd feel very comfortable putting about 90% of my portfolio into a single target date index fund that has inside of it is diversified for you. Thousands of US stocks, thousands of international stocks, thousands of bonds. And it's the simplest strategy, but it's going to beat most investors who are kind of like frantically guessing and making things overly complex.
I love the perspective, right? And I think what's so fun about this show is you're right. Like, we align on a lot of stuff, but we also don't on a couple things, right? So like, invest early and often. We are right there with you. Live below your means. We're right there with you. Keep it simple. We're right there with you. The only thing I think that's so funny is I didn't take you as a target date fund guy, because with us, we always thought that the sort of these target date funds over a long period of time obviously underperformed the S&P 500. And Robert and I think, right, it's like, if you're going to be invested for decades, let's say you're even in your 40s, 50s, and 60s, right? You're not just going to sell everything overnight. So if you're going to be invested for several years, if not decades, might as well ride the wave of the S&P 500 and other indices versus, I guess, trying to like balance that between bonds and index funds and things like that as well. What's your perspective on that? Why do you choose sort of index fund focused target date funds for yourself? Is it because you do need some diversification with the bonds and the fixed income side of the equation there, and it's kind of happening automatically behind the scenes like target date funds do? Or is it something else?
I think it's important to break down like what's inside of a target date fund. If you buy a target date fund that's sufficiently far out, so if you're a young person, you're 20s, 30s, even 40s, and you're buying a target date fund that's 20 or 30 years out, it's going to be 90% stocks and only 10% bonds. And if you're saying you want no bonds, okay, fine, but like the difference between a 90% stock portfolio and a 100% stock portfolio is going to perform very, very similarly. So of that 90% stocks, about 60% of it is the US stock market, which is essentially the S&P 500. And so the S&P 500 is inside of a target date fund, but it also has international stocks and it also has bonds. And so why do I do it that way? Here's why. Because the last 15 years, the US stock market has crushed the international stock market. The next 15 years, is that going to happen again? Nobody knows. But if you look over history longer than 15 years ago, it's kind of more like a pendulum. Sometimes international outperforms, sometimes US outperforms. And if the US isn't the economic superpower the next 100 years that it has been the last 100 years, I don't want to put 100% of my portfolio in a single country's, stocks. That said, obviously the US is like an exceptional country. About half of the market cap of the globe exists in countries headquartered in the US. But still, all things considered, I think the market is very efficient and people know what other countries' stocks are worth. And so I'm going to diversify in those other countries. In terms of underperforming long term, I agree. And so most of the time you hold one of these target date funds, you are going to be 90% stocks plus, because some of them actually are more than 90%. But when I talk to people in, their 20s like you, Austin, they're aggressive like you are. They're like, yeah, I want to ride the wave. I don't mind the volatility. I want to be, all stocks. But when I talk to people who are like 70, they don't want whatever, clown is in the White House at a given time, or whoever's running the Fed, or whatever happens to the stock market, to have their nest egg get cut in half when they're depending on that income to survive at that point. And that's where bonds come in, right? That's where you're kind of taking some of your chips off the table. And target date funds do that in a way where it's not reactionary to the market. I would hate to see someone who's like aggressive, they're all in tech stocks until they're 65, then tech stocks drop 70%, they freak out, then they go into bonds, and then they're like, retiring with way less. And the only way to do that, in my opinion, that's kind of smart and systematic, is to just take a little bit off every year, which is what a target date fund does automatically for you, starting kind of in your mid 40s or 50s. It starts transitioning towards bonds. So then when you're 65 and 70, you have more like a 60-40 or 50-50 portfolio.
I think the key word there was systematic, right? Because you're 100% correct. That is exactly how target date funds work. Is it's a very systematic approach to investing over a long period of time. So I appreciate the feedback and the walkthrough.
Yeah, I'm on the other side of the fence about that. Everyone knows I'm not a huge fan of target date funds, only because I just believe over time I can pick a better mousetrap for performance. And I just am more of the ilk that you should have active management of your portfolios. And so with target date funds, they can be good for the right people that, have a low risk tolerance and are looking for ways to be safe with their money but still grow it, because let's face it, a lot of people that put individuals in target date funds, they're not there to really grow the portfolio as much as they are to sustain it and make sure it doesn't lose money. So that's where target date funds can come into play. But then you can also look at, like, even BlackRock right now has a new target income portfolio that is completely dedicated to bonds. And that one, they're saying is going to make around 6.7% per year gains. So I think it's just, this really leads us down the path that there is no one size fits all in personal finance. And that's why we bring on guests like Jeremy, is to hear a different side of the proverbial fence and decide for yourself what you think is the best way to go. So to summarize, for me, target date funds can have a place in people's portfolio. I believe that mathematically they would underperform something as simple as if I had a group of index funds like VOO, QQQ, and VGT over 30 years. I think my clients that I would tell to do that would outperform a traditional target date fund. But there is a time and a place for them. So I'm not against it. It's just not my favorite recipe for growth and sustainable, gains. We always want that positive arbitrage for people to build wealth. So that would be my take on it.
I would say the other side of that coin, though, is that I think of a target date fund as like the entire pie. It's got all the US stocks, all the international stocks, and all the bonds. And Robert, you're saying, I like these three slices better for the next 30 years. And you might be right, but you might be wrong, right? Because we don't know what the future holds. And so the target date fund says, instead of speculating on individual slices, buy the whole pie, guarantee yourself your fair share of all future growth of the full market. And then I say, with the other 10% of your portfolio, that's where you can kind of get into speculation, stock picking, and sector picking, things like that. That's how I see it.
Got it.
Well, speaking of speculating, you sold your software company about a decade ago, right? You mentioned for a little bit over $5 million. And there's a video on your Instagram of you recording your checking account going from $66,000 to over $2.2 million because you clicked the refresh button on it, right? Because you got the wire transfer after you sold your company. So how did you approach allocating this money in both a responsible manner while also enjoying it, right? You were probably in your 30s. You're still trying to be happy and have fun. You mentioned playing video games. I also play video games. But like, how did you go about, wait a second, I don't know what to do with this, right? I feel like it's kind of like a big responsibility when people inherit a lot of money or see a big sum of money. They get scared, right? They're like, I don't know what to do. Now, before you answer that question, Jeremy, as all of our listeners know, Robert and I don't just talk about investing, we're actual investors. I've been investing for over a decade now, and Robert's been investing for several decades. And this episode's sponsor, Blossom, allows us to not only invest, but also share those investments with other investors.
Yes, Blossom is a social investing app built around transparency, and you simply sign up for a free account, connect your existing online brokerage account like Fidelity or Robinhood or Vanguard or even Charles Schwab, and get started. It's that simple. Unlike anonymous platforms like Reddit and Twitter, Blossom users link their existing brokerage account to the app so that all of their holdings and portfolios shared within the feed are verified by actual data, leading to richer discussions and decisions. It's just never been easier to join a community of like-minded investors focused on building long-term wealth together. And with that transparency, it's just really awesome from an authentic point.
And for example, Robert, when I signed up for the app the other week, I chose to follow the dividends, passive income, and options communities for my personal feed. They also offer a one-stop shop dashboard for tracking all of your investments. They've got a dividend tracker, a dividend forecaster, sector breakdowns, and everything in between.
Yes, Blossom is not an online broker. You're not investing into stocks on Blossom. They're simply a social app network for investors that want to connect with other investors. Did we mention that they have 120,000 active users across both Canada and the US already? So go sign up for Blossom using the link in the description of the show notes, and we'll see you there.
All right, let's hear what Jeremy has to say.
Yeah, first on the bank thing, I had learned like a week prior to this day that the bank emails me when I get a wire, and I'd never gotten a wire transfer before, but I got one like a week earlier when we drained some of the money from our bank account in anticipation of the sale. It happened like that. You just click refresh and there's all the money. Before that though, there's about a 3-month period of due diligence. Basically, we had shaken hands with the buying company on the purchase price, but the wire hadn't come through. And in that period, you never know. Like if they back out or they go bankrupt or whatever, the deal's not really done until the wire comes through. But I had basically 3 months to think about it. And I got to do a lot of thought experiments. I thought things like, I could go buy a Lamborghini. What's a Lamborghini cost? A couple $100,000. I would still have 2 million left or 1 million left or whatever it is. Still plenty. Then I was like, where would I park it? And what would I say to my friends when I just rolled up in a Lamborghini? Like that period of time really gave me, some like time to decompress and think about, how would I really spend this money? And what I came to is like, there's fewer opportunities than we all assume to convert money into happiness. If you're broke and you like can't pay the lights bill, then absolutely like having more money is going to make your life remarkably better. But if you're like at a level of comfort, making $70, $80, $90, $100,000 a year, buying a first class ticket instead of a coach ticket doesn't really add, it's for sure a comfort and it's a luxury, but it doesn't really make you like internally much more happy. And driving a nicer car doesn't really like give you like a real strong feeling of happiness throughout the day. And so basically I want to use that money to what I think is, and I still think is going to buy me happiness, which is freedom. I didn't want to buy a bunch of stuff to have to be a slave to and be like, oh, I have to make a car payment, a house payment, a country club membership payment. I want to like build that wealth so I could live off the growth indefinitely and then basically spend my free time, spend all my time however I see fit. And so to put it succinctly, like the day I got that wire, the next day I decided to do a lump sum investment. I chose about 6 ETFs. I dumped all in, kind of contrary to my target date fund I suggest now. I chose a total stock market ETF, a small cap ETF, an international ETF. I did commodities like gold and oil, real estate, some international real estate, just like a few different ETFs like that. And there they sat basically since then, bringing my net worth from about 2 million back then to over 5 million as it is today. But I did go back and do the math. If I'd bought a target date fund on that day, I would actually have about $600,000 more money, because despite all the complexity I introduced, it underperformed the total pie of the market.
Interesting. And what I think is really cool about your answer, though, is the ability to buy freedom, right? I think that's what everyone's sort of working toward, and something that we really care about here on the podcast is, financial freedom and what that means for people listening. It means something different for everyone. And, at the end of the day, a lot of people listening right now are those solopreneurs, small business owners who are working toward maybe having that exit or selling their company or doing something big like that, Jeremy. So that's a really cool answer. And I totally agree with you, man. My big thing as well is like, I'm 28 years old. I want to get to a point in my life where my investments completely offset my monthly expenses, my annual expenses, and I'm super quote unquote financially independent.
Yeah. And I want to touch on, not many people really ever get to see a windfall like that. And you hear it all the time with athletes and musicians and actresses, or actors when they get that first big check. You hear it all the time that the athlete signs the $40 million contract. They get a $10 million signing bonus. The first thing they do is go out and buy everyone close to them a new car. And they buy a few houses and they do all that. And the biggest mistake, and you touched on it, Jeremy, and I want everyone listening to make sure they really listen on this point, is when you know that windfall is coming, you need to pause. You need to try and really bridle in the excitement of that $500K, $5 million, $10 million, whatever it is, whether it's inheritance or an exit of a business, you need to bring it in for a while. And if you have to, go spend a weekend alone in a cabin, go do a staycation, because what happens is you let everyone around you hype you up. Oh my God, you made it. You're finally rich. You're getting millions of dollars, et cetera, et cetera, et cetera. And what happens is, and it happened to me, and I want to touch on this for a moment, is you get so overwhelmed by it that you think the money is never going to stop. And that's why so many athletes go broke, because the siphon can get turned off just as quickly as it gets turned on. And it's just so important for people to pause for a minute, really look at how long this money is going to last if they handled it correctly, versus going hog wild and buying a Lamborghini and new houses and taking care of everybody. Because it might sound weird, but $2-3 million, if you start going crazy with, depreciating assets, it will run out quickly. Trust me. You go buy the house, you go buy the car, you go buy the boat, and then maybe a couple other things. Pretty soon you're going to be like, oh shit, what did I do? So I think it's really important for everyone to pause when they know that money is coming in. And I'm going to tell you guys a really great story during Silly Bands. At the height of Silly Bands, when millions and millions of dollars were coming in, I made 2 mistakes. 2 very big mistakes. Not big enough to ever go broke, but big mistakes. Number 1 As it started to slow down, I thought, oh, I can take this $20 million, $30 million now, and I can turn this into $200 million as easy as I turned this into the 20 or 30 million. That was mistake number one. Mistake number two is Tim Croak, my cousin, the founder of Croak Capital. One day he walked into my office in the middle of the madness and he just sat down. And I'm like, uh-oh, what's wrong? Because he never just shows up. And he said, I want you to write me a check for $5 million right now. I'm like, what do you mean? He goes, I know you. He goes, you've never made this much money before in your life. And he goes, and I want to take $5 million away from you now so I can invest it properly so you make $500,000 a year for the rest of your life. And he goes, and that's what I want you to do right this minute. And I didn't do it. I wrote him a check for $1 million on the spot, which was smart, which was great. But I just felt that I was the king of the world during that moment. And I didn't do the pause. I was so busy making so much money. I thought I was just the king of the world. Don't make that mistake because it can leave you as quickly as it comes if you're not smart with the money. So everyone listening, if you're coming into a windfall, I don't care how much it is, it's so much better to put it away, give yourself some time to breathe and think and see what happens next before you go out and start buying all these depreciating assets.
I love that. One thing I learned when I sold my company is that there's no limit to how much you can put in a savings account. And you could just, if you got, whatever it is, 100,000, 10 million, you can just go dump it in a savings account and just leave it there for 6 months, right? And I think leaving cash alone for 6 months, you're never going to look back on that and say, that was a catastrophic mistake. The opportunity cost of 6 months is what ruined me. That's never going to be the mistake. But I think it does give you that time to decompress, like let the craziness die down and help you avoid making those like kind of in the heat of the moment, knee-jerk decisions, which can, be dangerous.
Yeah, definitely.
Now, Jeremy, before we jump into your new company, which I'm really excited to learn more about, I want to backpedal a little bit to your answer before Robert here was talking about his Silly Band days, because you said something about how your investments now pay for your life, right? You were pretty much saying that you're financially free at the moment. How is that broken out, right? I think you said you have about $5 million in net worth. How is that between if it's real estate or your target date fund or any income generating assets? Like, how are you paying for your life right now from your investments?
Yeah, that's a good question. A lot of people ask that because it seems so abstract. Like, how do you live off your investments? In broad strokes, you just buy a bunch of index funds or ETFs or stocks or whatever it is. And then when you want to live off that, you just sell a little bit every year. And so, for example, they say the safe withdrawal rate is 4%, which is, a very broad strokes number. But basically, if you have $1 million invested, you can take $40,000 per year out every year, even increasing it for inflation and never go broke. And so, Robert, when you said your brother was going to take $5 million, I was like, is the mistake writing him the check? Because that sounds like a good idea. And your mistake was not writing him that check because he knew that. He's like, hey, if we just go and put this in like reasonable investments, then you're going to have forever income, and you can just, whether the market's up or the market's down or it's producing dividends or whatever it is, you can just basically either take those dividends and put them in your checking account and live on them, or sell a few shares or sell a couple percent per year, whatever it is, and put that in your checking account and live on it. And that's essentially what I do. Now a couple of other sources of income, like my passion projects has kind of become a side business, which has become like a business. But, basically when I need money, I go to my ETFs and I sell $50,000 or whatever at the beginning of the year and transfer it into my checking account, and there it sits. And my $5 million is about $1 million is in my home. I live in San Diego, and so my home is a 2-bedroom condo. It's not a mansion in San Diego for $1 million. About $3 million is in ETFs, like those ETFs I mentioned I bought when I sold the company, and the other $1 million is some equity I have in my businesses, some real estate, some angel investing, like stuff like that. Kind of what's $1 million between friends, right? Just some other assorted stuff.
You mentioned you're in California. Obviously you could be there for a plethora of different reasons, but considering like the tax rates, and I would argue that you're definitely on the wealthier side. Like, have you thought about living somewhere else? That ever been like an equation from a tax perspective? Like, after you got this amount of money, was there ever like, wait, how do I best optimize perhaps tax strategies or different types of ways to just make sure that you're not paying $100,000, $200,000, $300,000 of this back to Uncle Sam?
I've been asked that question too. And I think that's kind of funny that, when you get more wealthy, you have to move because of your money. I feel like it should be the opposite, right? And so my take on it is, since I have all this money, I can live exactly where I want to live, regardless of the cost, regardless of the high home cost, regardless of the tax rates. And so I'm living exactly where I want to live. I live like a mile from the beach in Southern California. I think it's beautiful. I love the area. I love my friends. And so I live here because I can afford to live here. If I had like $1 million and I was trying to retire early, then I might, kind of do some geo arbitrage where you either move to a low cost of living city or a low cost of living country. But I think I'm at a point where I'm not super rich, like I'm not Robert Rich or whatever, but I'm, good enough where I can at least like cover my cost of living in San Diego. So that's where I choose to spend my days.
Dude, I love that, right? And that's the whole thing, right? We are financially free so we can make whatever decisions we want, right? We can live where we want, we can hang out where we want, we can spend our time how we want. I love that. Now, the new company, right? You have a new company. It's called Nectarine. Talk about that. What inspired you to come up with this idea? How did you hire all of the financial advisors behind the scenes? What was the vetting process like? Give us the play-by-play as to what Nectarine is. And if anyone's listening right now that would want to be a customer of Nectarine, what benefits come with that? Like, give us just the walkthrough.
Man, what a setup for a plug. Thanks, Austin. But basically, the last 5 years, I've struggled with one of these questions I get asked. So when I'm talking about personal finance and investing like you guys are, the question I would get asked is, how do I find a good financial advisor? And the word financial advisor itself isn't regulated. And so anyone can put that on their business card or the nameplate on their door with like reckless indifference to what they actually do. And there's lots of insurance salesmen, for example, who love that because they claim to be financial advisors.
Yeah, IULs are a great thing for everybody.
Well, like when we like the target date fund thing, we're 90% online. That's maybe a little bit, but like we're basically all on the same team here, except for the insurance salesman, right? Because they only get paid if they sell this one specific product, which in my opinion and experience is a horrific product.
In ours, it is also horrific. We're right there with you.
Right. And like, it's just like they paint this picture that all these like rich people are buying insurance to get rich. I was like, no rich people I know are buying insurance to get rich. I literally know lots of millionaires. None of them do it. But when a young person goes and seeks out a financial advisor, I'm making air quotes if you're listening to this on the podcast for the first time, like I think more often than not, they find themselves either in the office of a commissioned insurance salesperson or a commissioned financial advisor who's just gets paid for pushing specific high fee products, whatever it is. Like I know you guys have mentioned in a past episode, sometimes you look at a financial advisor's portfolio and they have like 50 different actively managed funds that are all high fee. And, in my opinion, they're basically introducing complexity in order to prove their value, right? They're like, this is so complicated that I have to be here, right? And so when people have asked me, how do I find a good financial advisor? I've always been like, that's tough. But I do think there's kind of a simple solution. And the solution is pay the financial advisor for the advice, not for the products they're selling you. And that model is called advice only. Advice only financial advisors don't manage your money. They don't push any products. They don't earn any commissions. They don't sell anything. They simply sit down with you next to you as a partner. You pay them for the hour or for the project, and they give you their expert opinion. They're CFPs or CFAs or fiduciaries, whatever the case may be, but they're just getting paid for the advice. And so I'd usually give this pitch to people the last 5 years, and then the young investors would say, that sounds great. How do I find one of those advice-only fiduciaries? And my answer was, I have no idea. There's very few of them. They're kind of hard to find. They all have different business models. They're hidden out there. So enter Nectarine. That's why we built Nectarine. It's an advice-only financial advisor marketplace where we can go, and it's $150 for an hour. All the advisors have agreed to that pricing. So you can filter based on their expertise, based on where you are, based on what you need. You can see their live availability right on the site. You can book right through the site, see the reviews. You can record the meeting if you choose. You can see the recording and you get like kind of a wrap-up email with the notes from your hour. And so far, our average review has been like 4.95 stars because I think to those who have met with a financial advisor before, it's like a breath of fresh air to be like, oh man, when they're not trying to sell me something, suddenly it feels more like a partner who's like giving me advice, not pushing me in a specific direction that feels a little bit weird to me.
Yeah, we've been talking a lot about it with Crow Capital, since I've gotten so big in the financial education space, is allowing people to come on and pay an hourly rate or a monthly retainer, $2,500, $5,000 a month. And we're an independent, but what people don't realize in a lot of instances, so I love what you're doing with Nectarine, is that when you go into that office, your best interest is not in their mind. They're going to tell you it is, but they're going to sell you based on the products that they make the most money. And that's why with Crow Capital, even, we're an independent. So we can work with whoever on whatever we want, which is nice. My family, not me. But I love it because I do a lot of this educational process with people on a daily basis, and it is a breath of fresh air because I have nothing to sell them. I am just taking my 35 years of experience and saying, hey, this is what I would do if I were in your position, given where you're at financially, where your business is. Do you have a trust? Do you have whatever it is. And I think it's so great. So I'm going to definitely look into it more just because I think it's something that is greatly needed in society to give people a piece of, a lot of people book with me because they know they're going to get the straight shot. And that's so important because whether people have $100,000 or I deal with people every day that have 10 million plus, they just want to know how to optimize their portfolios and their businesses so the positive arbitrage goes in their favor and they grow their wealth. That's it. They don't want the games. They don't want the high-pitched sales and all of that. So I really like what you're doing and definitely can appreciate it, and I'll check it out more.
Thanks. I think the industry is moving that way. I feel like in the 90s, when like the internet was kind of in its infancy, you kind of had to walk into a broker's office and,
Right.
Whether it's insurance or investment products. But, we live in a different world now. Investing in the world's stocks and bonds are at everyone's fingertips on your phone. And so we don't need to be paying these commissions to get access to that anymore. And also, I think consumers are kind of wisening up to the weird incentives that are presented by these other business models. And so I hope you guys do offer that flat fee service. I think it's a great idea. And I think the industry is going to move that way. And by the way, it's at hellonectarine.com if you want to check out Nectarine.
It's just getting people to understand the difference between a fiduciary and a non-fiduciary. It's a huge difference. And people are very often misled and they don't understand that with a fiduciary, you're not paying commissions, because you see these companies, like you said, that are buying and selling all the time with 50 different instruments. It's because they get a commission on every buy and sell, and they're not really looking out for the customers, what's best for them overall.
And I think it's really cool that Nectarine is this marketplace solution, right? For people who just want that straight up advice. They don't want the large planning. We're not saying that people don't need financial advisors, right? Obviously, financial advisors exist for a very good reason. And when you're at that stage in your life where you do need to start thinking about your entire financial picture, if it's with the college savings or if it's with your tax optimizations or your trusts and your estate planning, like financial advisors are awesome for that stuff. But if you're 32 and you don't know where to invest $100,000 because you just don't know, Nectarine sounds like an awesome platform to find someone who's going to sit down with you for an hour and explain to you what's going on, as well as where you should probably park that money.
It's kind of amazing how the advice changes when the conflict of interest goes away, right? Like you have no conflict of interest other than you like your friend and want to do the best for him. And suddenly, the fiduciaries, that word is kind of problematic because in my experience, every single financial advisor or every single person in the space will say that they're a fiduciary, even if their business model isn't a fiduciary business model, right? Like they say they're fiduciary, but they only get paid if they push these certain products. So it just turns out that's what they think you should do, right? When you take away those incentives and just say, okay, pay for your time, then you can actually sit with an expert. I think that is a breath of fresh air for investors.
Well, it's kind of like in business, Jeremy. I always tell people, don't get all your business advice from your business lawyer, because at the end of the day, they may not know what is best for you of how to grow your business, how to exit your business, what are the best tax strategies, what are the best marketing strategies. And I think that's why people like the three of us are so important for so many people around the world, because we have the experience and the knowledge firsthand, not just from school, of how to do all these things and how to handle the problems that come along the way with life and building business and building wealth and exiting businesses. Before we wrap things up, we're all humans and we've all made mistakes in our financial careers. And Austin and I have been pretty vocal about our mistakes over the years. So if you're comfortable, share one of your biggest financial mistakes. And it doesn't have to mean losses of capital. It could be missed opportunity. It could be something that you knew you should have done and didn't do. Give us an example for the listeners.
Now, before we hear about Jeremy's biggest financial mistakes, we want to take a moment to talk about Moby. Moby is an up-and-coming research platform used by over 5 million investors to help them make better informed decisions. Between their consistent market updates and individual stock picks, it's been really great becoming weekly users ourselves. I actually discovered Kava after their IPO on the Moby app, and their stock is ripping, Robert.
That's right. I really didn't know about Moby at all last year until you mentioned it, and I really started watching it and learning about it. And their weekly stock picks are awesome. And I love how straightforward they are, and they don't make analysis overcomplicated, which is always so important to our audience. So you've all heard me talk about analysis paralysis being a big issue for investors, and I feel like Moby does a great job of helping retail investors be efficient with their time and not overcomplicate communicating things. Their graphs are really great. And especially those of you that are really ready to diversify into single stocks and you've built your base already, I think Moby is a great platform.
Yeah, Robert, their 2023 picks had an average return of over 30%, and their 2022 picks during a bear market had an average return of over 35%. It's pretty unreal.
You know that the ultimate goal of the Rich Habits community is to help you take back control of your money, and Moby is one of those tools that I truly believe will help you do just that. You know, we're always breaking out the new stuff and trying to give you the best of everything that we research. And so check out the link for Moby Premium in the show notes below and in our stand stores. As always, let us know if you have any questions, but we love Moby and think it is a great tool.
Yeah, Robert, I'm a stock analyst myself. I enjoy analyzing single stocks, and I actually use Moby to not just kind of check my work, but find inspiration. So if you want to get inspired to find some single stocks, go check out Moby in the show notes below. All right, let's hear from Jeremy.
I'll give you some quick ones. I've done a lot of dumb stuff. I invested in like an oil drilling operation I didn't understand. I lost $40,000 and went to zero. I invested like $20,000 in Sears Canada. I was like, it had gone down, like it's going to go back up. It went bankrupt, lost my money. Invested $10,000 in Lyft. That's down 75%. Still hold that one. But I'd say that my biggest mistake is not the losers that I've held, but the winners that I've sold. When I sold my company, I bought $400,000 worth of the stock of the company that acquired my company because I believed in them. I kind of knew that they had a good business, and that $400,000 doubled to $800,000. The share price went from 12 to 24, and I sold like 80 or 90% of it. I like doubled my money. I called myself a champion. Today, that share price is $230. So that $400,000 would be worth about $9 million had I not sold. And so I think that, maybe my, conservative nature of investing has cost me there, or if I would have let my winners run, if I would have held that for longer, even if, instead of selling 90% or 80%, if I sold 30%, kind of took a little bit more aggressive stance towards that, I would have been, in a dramatically better financial situation than I am today. With that said, at the time, it could have gone from 800,000 to 100,000, and I would have felt like an idiot. So we don't know in the moment, but I think, letting your winners run and maybe selling your losers might be a strategy that would have served me better.
That's so funny you say that because, and by the way, you got to tell us what the actual ticker is because I want to go check them out too. But I saw a video today on Instagram. JD Durkin is the guy who posted it, works at the New York Stock Exchange, and he's awesome. But he essentially said, if you bought Apple stock at IPO, what would it be worth right now? Just 10 shares. And it IPO'd at $22 a share. And so that's what, $220. Your $220 after all the stock splits and everything over the time would be worth over $500,000 today. $220 to $500,000. He's like, but no one has that because you see, to your point, Jeremy, the 2x, the 3x, whatever it is, and we sell because, you can't get mad at yourself for ever making a profit. That's incredible. We should all feel good about that. But dude, I am right there with you. Some of my biggest financial mistakes come from selling my winners too early.
Yeah, every time someone bemoans their bad luck in investing where they sold too early, I sent him a screenshot of when I sold my first 100 Bitcoin at $700 a piece. And I thought I was a genius because the dollar cost average on each one of that section of Bitcoin was like $47. And so, we feel like we're geniuses, but I also think you can't look in the rearview mirror. You have to always just look at it from an ROI perspective because no one on earth, I don't care how famous, popular, or rich they are, no one ever always gets it right. No one sells it at the top when it is truly the top. No one ever gets it completely right. So I just tell people, have a thesis and an understanding that works for you, whether that is when you get to 100%, 200% return, you take 50% off the top and let the house money ride, whatever that may be, and do your best not to look in the rearview mirror because, if I looked in the rearview mirror, Jeremy, and Austin and I figured out the math. I was at an investment group meeting to be one of the last people in Uber. And my $25,000 that as we left the building that night, I decided not to put in the next day because the next day I think was the last day of it. My one friend did and the other two of us didn't. And that $25,000 adjusted for everything over time would be $7 million right now. So, but you just can't do that to yourself, especially at our level, because you'll drive yourself nuts. And then what happens is you pull the trigger on too many projects and you find yourself losing and having a bunch go to zero.
I fully agree. And everyone has that story. Everyone has like, if I multiplied this by this, where I would have been. But the thing is, you probably wouldn't have $7 million because you would have turned that 25 into 125 and called yourself a genius. Just like, I remember when Bitcoin was 10 cents a coin. And I'm a computer scientist, so I just remember learning about early on I was like, nah, I'm not going to buy that. There's no way it will ever be worth $1. And of course, like do the math on that, I'd be a trillionaire or whatever. But we all have those mistakes, and you're right, time only marches forward. And so buy, acquire. I think that's what's going to serve us well over time.
Yeah, not have knee-jerk reactions. So everyone listening right now, Jeremy, this has been amazing. I love it. Please, 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 please listen. Don't have knee-jerk reactions. Buy. Use the dips as an opportunity, and just look at investing as a long-term play. You are building wealth long-term. If you think it's in and out and filled with emotion, you're a gambler. You're not an investor.
100% agree. I always talk about speculating versus investing. Investing is buying and holding over time. Speculating or gambling is jumping in and out, guessing, making those knee-jerk reactions. Those are the people who are going to still be broke in 40 years looking for their next get-rich-quick win, not the people who have been accumulating shares over time.
Thanks so much for hanging out with us on this episode of the Rich Habits Podcast. Just as a quick reminder, that was hellonectarine.com. We'll have the link in the show notes below. And hopefully we'll have you back here pretty soon, man. Maybe get the update when you hit 10 million.
I would be honored. Thanks so much for having me. It's been a blast.
See you soon, Jeremy. Thank you.